This is Julie from Sanity Spot and Sanity Spot for Teens, and I wanted to take a minute to talk about Snapchat. In my live class today, I mentioned that back in 2017, when Snapchat went public, I was teaching a class that day, and so my students and I were sort of following and watching what was going on. And the process of going public is actually kind of complicated. A company might spend months trying to figure out how much of the company to sell, what the stock is going to look like, whether they want to sell in the public market or if they want to sell privately. But obviously, if they're going public, they make a decision that they're going to sell out on some stock exchange. It might be the New York Stock Exchange, it might be the NASDAQ, but the company's decided that they're going to let members of the public buy pieces of the company. And I mentioned in my class today that once you've got a whole lot of owners of your company, there needs to be some way those owners want to have some sort of voice in the way that the company is run. So a shareholder becomes an owner, and what they own is, sorry, just making sure that this is. So when a shareholder becomes an owner, what they own is the assets of the company and the future income. So they want a way of making sure that the assets that they own and the future income that they think they're going to get a piece of are well taken care of. And they might decide that they don't like what the current management of a business is doing. So there needs to be some way for shareholders in a company to influence the owners. And the way that that's done for publicly traded companies is they elect the board of directors. So they elect a group of people who, they call it sitting on the board. They're elected by the shareholders, and that board of directors then hires management. Now, some people might say, well, the board of directors just kind of rubber stamps whatever management wants to do. They don't really make any decisions. And that's sometimes true, but it isn't always true. And the real key is who holds the share? Who holds the shares? So if you have enough shareholders, if you can get enough shareholders together that you control 51% of the voting stock, then you get to elect who's on the board of directors. So if you're the founder of a company and you don't want anybody to overrule the direction you want to take the company in, your answer is don't sell off more than 51% of your company. Now, here's the interesting thing. When Snapchat decided to go public, they were trying to figure out things like how many shares to sell and how to market their company, because that's a thing you have to do. People don't just automatically know, hey, I want to buy shares of this company. They've got to show people what their assets are, what their future income is going to be. They've got to kind of lift up the rug and show everything that's been going on. They've got to tell future owners everything. So once a company gets into that process, then another really important thing that they have to do is decide the price that they're going to sell their shares for. So in the time leading up to selling your shares in the market publicly, which we call an IPO, initial public offering. First time we're going to offer our shares to the public to buy. So in the time leading up to the IPO, the company's trying to sell themselves, and they're trying to figure out, what should we sell our shares for? because the stock market is this open auction. So anybody, the value of a share is basically what is someone willing to pay for it. And shares are trading back and forth, and the only way that you will ever know how much a share is worth is when somebody says how much they'll pay for it. Initial public offering, you don't know what anyone's going to be willing to pay for shares in that company until you start trading. So in the time leading up to the initial public offering, you're marketing the bank that's helping you with this is marketing your shares, is kind of shopping them around to see who's going to buy them, who's going to be interested, because the last thing that you want is on the day of your IPO, you don't want those shares not to sell. So generally, companies try to underprice their shares a little bit. They'll sell them for slightly less than what they think people are willing to pay or investors are willing to pay, because they certainly don't want nobody to buy this. So in the time running off, the IPO was on March, I want to say 3rd, might have been the 2nd, but March 2nd or 3rd, 2017. And in the weeks running up to this, they had floated prices from $14 a share to $16 a share. So that was what they were going to sell their shares. It's really important for a company to get this right. I just said they don't want no one to buy the shares, so they want to price them a little bit less than they think that investors are willing to pay, but they don't want to underprice too much, because once a company sells its shares in the market, that's the only money they're ever going to get for those shares of stock. When you and I trade them among ourselves, when they go out onto the New York Stock Exchange, and if I bought that Snapchat share and then I turned around and sold it, I get the increase or the decrease in money, in the value. So Snapchat wants to make sure that they're getting as much money out of this IPO as they can, but they don't want to embarrass themselves by not being able to sell the shares. So they went to their IPO telling people they were going to be selling from somewhere between $14 and $16 a share. They actually went out at $17 a share, which was slightly higher than they had said. When this IPO went public, I was reading about it. I was talking to my students. We were looking to see what happened during the day, because it's kind of a big, exciting time for the company. I'm sure everybody in the company was watching to see what happened to those shares that they sold at $17 a share. They sold all of them. There weren't any leftovers. And then once they sell these shares for $17, then they're out on the stock exchange. Yeah, that's right, New York Stock Exchange. Then they're out on the stock exchange, and they're going up and down minute, second by second. The interesting thing, there are two very interesting things about the Snapchat IPO. Number one, and this wasn't all that unusual for .com or virtual companies, they really didn't have any revenue. They didn't have any income. So this truly, they didn't really have any assets, and they didn't have any income. So truly the only thing that you're buying is the idea that they're going to have income in the future. Or you're buying the idea that the share price is going to go up and you can sell the share to somebody else. So those are really the only two things that you can think are going to happen if you're willing to buy this share. But I just talked about how if you're a shareholder, you're an owner in the company, the owner elects the board of directors, and the board of directors hires the management. Snapchat decided, you know what, we don't want to mess with that. We saw what happened to Steve Jobs. We see what happens to other tech companies. And you get all these owners, all these shareholders coming along who want to tell us what to do. We're not going to let that happen. So we are going to break this cycle. We are saying that all of the shares that we are selling are non-voting shares. You don't get to vote on the board of directors if you buy a share of Snapchat. So to me, what that was saying was, if you buy a share of Snapchat, what you are interested in is how much can you sell this for the next day. You're not really thinking of yourself, you're not encouraged to think of yourself as an owner with a long-term stake in the company, because you have no control. You have no say. Nobody has any say. There's no checks on what the management, who were the founders, can do. So what happened? Snapchat actually went up. It had a really good first day bump. And by the next morning, shares were trading at somewhere around $24. There's a range. Obviously, it's moving all the time. But the share price had gone up about 40%. So that was great. Everybody was happy. The people who work at Snapchat, there were a lot of millionaires, multimillionaires, billionaires made that day, because when a company breaks itself up into all these pieces, they usually take chunks of those pieces and hand them to upper management. The founders get some, even if you weren't a founder, but you're one of the original employees, you're going to get a chunk of the shares. And there's rules about how quickly you can sell them. You don't get to just turn them into money right away, but you have stock that's worth a lot of money. Now you're going to be watching what this share price does, how it goes up and down, and for most companies, it's because the shareholders are electing your board of directors, and they're going to be telling you whether or not you still have a job. If they're not happy with you, you're going to get booted out. In this case, for Snapchat, you didn't have that option. There was no way you were going to be able to boot any of the management out if they were doing a bad job. But your share price, you were going to watch what was going on with the share price. So in the 2 years, it's been 2 years since that initial public offering, what has happened? At the 1 year mark, Snapchat was still doing pretty well. It was still above its IPO value. People are still making money off of it. But here's the interesting thing. There were no physical assets. There was nothing on Snapchat's balance sheet that we could point to say, yes, they had real wealth. They probably still had some cash left over from their IPO, but they didn't have any real assets. The only asset they have is something virtual. They have visitors. We don't really know how to value that as shareholders. Is this something that you can turn into money? Is this something you can monetize? And Snapchat believed that it could, but the power of a brand like Snapchat is pretty delicate. And as soon as all those hundreds of millions of users decide, you know what, Snapchat isn't cool anymore, and they start moving to another platform, then those visitors are gone, and Snapchat doesn't get any money for them. There's nothing that they sold and received in exchange, so they aren't real assets. As of right now, 2 years in, Snapchat's shares are selling for about $11 a share. Not too long ago, one of the Kardashians made a comment about Snapchat that it was sad. And every time, any kind of platform, every time they roll out a new platform and improvements and they're changing the way that it looks and feels, people don't like it. We don't like change. So generally speaking, people are going to respond negatively to any kind of improvements in a service like Snapchat. But I think I read that there was something like 1.3 million signatures on a petition asking Snapchat to roll it back to the previous iteration of the app. So here's the thing. When you're investing your money in something like Snapchat, if you invest your money in something like Snapchat, we're going to talk about investment strategies later on in the week, use Snapchat as a lesson. So the only people who've made money off of Snapchat were, these owners, they did make money. They're going to feel like they lost a lot of money because at one point their shares were trading for $24 and probably higher than that at some point, and now they're trading for $11. That's still $11 that basically appeared out of thin air or appeared out of them selling their company. But for them, they feel like their net worth has gone down a tremendous amount. People who bought shares at $24 and still own them and they're worth $11, they also feel like they lost. And actually, they have lost money if they are forced to sell at $11. But the people who did well out of this would have been someone who bought for $17 and turned around and sold for $24. So a company like this is encouraging you to think in terms of being a speculator, being a trader who goes in and buys something and makes money on flipping it over and selling it quickly. One of the things that I want to teach in this class is not to look at stock that way. I want you to look at stock in terms of an investor, and something that an investor probably isn't going to tolerate is this idea, this kind of disrespect or contempt for the shareholders to say, you don't know what's best for our company, we know what's best. They might be right. I mean, we don't know how to run Snapchat, but the idea that you can sell off this whole company and say that no one else in the world knows as well as we do how to manage this company, that might be true now, but it might not be true forever. And they've taken away all of the shareholders together their right to decide that for themselves. So is Snapchat coming back? I don't know. I don't know what's going to happen, but it's an interesting lesson, and it's something to go out and read about. Take a look at Snapchat. It's interesting because it's something that you use every day, and sometimes when you're encouraged to start investing in stock, they'll tell you to go out and look at companies that you know and things that you like and start investing in those. That's not always a great idea. So that's the Snapchat story.